Hi, my name is Nav Mathur, and I'm a Senior Director at Neo4j, the leading graph database platform. And today I'm going to talk about future-proofing your risk management and compliance with graph technology. Today's financial services firms face a maelstrom of dizzying regulations. If you look at this picture here, all kinds of acronyms and rules and from LEI to BCBS 239 to FATCA to Basel, the Basel Accord, so 1 through 4, and so on and so forth. And all of these regulations need to be complied by. Financial services firms are really spending a lot of money and resources trying to do just that, attacking this problem with multiple teams focused on different regulations, even though the data set is fairly common across it. All of these regulations. So today we're going to really focus in on FRTB compliance, which is the fundamental review of the trading book. And this is really talking about trading books and banking books and the assets that are traded therein, and the capital reserve requirements that financial service institutions are required to maintain as a backstop to trading losses for their trading activities. So essentially, you have trading books that are basically used for trading highly liquid assets, frequently traded instruments like stocks, bonds, options, things like that. And for trading book assets, banks are required to maintain a higher reserve requirement, so additional liquidity, because those are riskier assets. Banking books, on the other hand, are used to maintain assets that are held to maturity, and so since they're not traded frequently, the risk associated with those assets is typically low, and so banks are supposed to maintain a lower reserve requirement for that, so they don't have to have as many assets and liquidity as the trading book. A typical example of a banking book may be a corporate loan, for example, which usually is held to maturity. So for trading books, banks can either use an internally developed model, which needs to be submitted to the authorities and passed. If the model passes, then there are lower capital reserves associated with that risk model, and so that gets approved by the authorities, and so then banks have an incentive to essentially get an internal model developed and have lower capital reserves associated with the trading books. Otherwise, banks are supposed to follow the model provided by the authorities, and in that case, typically the reserve requirements are much higher. So in order for banks to put more capital at work and be more profitable, it is incumbent upon them to develop these risk models and submit them for approval. So for our demonstration today, what we are going to show are trading desks that have a bunch of individual stocks, bonds, any trading instrument really, and they can also contain baskets of other trading instruments, and then the individual, obviously, equities and trading instruments, and then their prices. So this, if you can look at it from left to right, so you have for example, an energy trading desk, which is shown here, which may contain a batteries basket, a solar basket, and some individual stocks like Tesla and so forth. The batteries basket in turn has some indexes and individual stocks, and then those stocks and indexes have price points associated with them. Now, for a bank to be able to submit a risk formula or risk methodology for approval, they need to have this lineage very well understood, and they need to actually historically test back 10 years to specific price points on that risk model that they have developed, and ensure that it stays within a particular defined range. And not only that, going forward, they are supposed to maintain 24 price points per year, so 2 price points per month, against which they continuously test that model going forward. So all this is part of the regulation around FRTB compliance. So this is a pretty dynamic structure if you really look at it. As trading activity happens at a trading desk level, at a basket level, stocks are coming in and out of these trading desks, and so the lineage that needs to be maintained from trading desk to the baskets to the individual stocks to the prices keeps changing dynamically based on the trading activity. And then if you look at the reverse, going from prices of individual stocks all the way to the desk level, the risk scores are getting aggregated, recalculated every single day as they need to recalculate risk on a daily basis, again, as per the requirements. For this system to really work in real time as is being required for compliance purposes, this is really a graph, and a graph database is best suited for this type of activity of maintaining lineage without having a break. So essentially ensuring that the database that you use for this is clustered and is ACID compliant, and then also being able to aggregate and calculate risk on a real-time basis. This chart really shows price points. So basically it's showing 24 price points, 2 price points per month for every tradable instrument that is required to be maintained over time. And as you can see, as time passes, these price points keep changing as you kind of remove a price point from the trailing months and add price points for the new months as they come along. So again, that lineage is fairly dynamic. And the risk level needs to be maintained in that green zone for the most part for the risk model to hold. And if risk at any point goes into the red zone, then the risk model will need to be re-reviewed and resubmitted. So to summarize again, we're tracing the risk from trading desks to baskets to the individual trading instruments to the prices. So we're tracing the lineage backwards all the way to prices and maintaining those price points for every equity associated with the trading desk. And also we're aggregating risk going up through the trading desk. And so if you can appreciate from a model perspective, you have trading desks, you have baskets and fund management systems associated with the trading desks. You have trade and position data that is coming in from the real-time market activities. And then you have your core banking platforms, your loan platforms, and market data feeds that are coming in for pricing and other risk calculations. And in our case, we're using RSI, which is a relative strength indicator, and ROC, which is the rate of change, as proxies for risk calculation. And so if you look at an overall risk management platform, all of these data sources that are connected together, and then you have a risk management application, a compliance management application, and then also you can take advantage of all of this connected data by doing a lot of business analytics on top of this data to be able to make business decisions faster. Such a risk management platform has a lot of benefits. Obviously, we've shown that you can span all these data silos and bring them together to model risk and to provide the underlying data for these risk calculations, tracing the data lineage, aggregating the risk, having the auditable precision, so being able to use real-time data for all the audits, reports, and decision making from a common platform. So you don't have separate platforms for compliance and separate platforms for operational risk management, so that reporting is actually happening all out of the same operational platform for accuracy. This also helps in maintaining data consistency, and so you have a lot of times you're creating reports as of a particular date and time, and you need all data to be accurate as of that particular date and time. And we know that data keeps moving from system to system, and so what data changes in what system at what time may not be very well understood unless you have maintain a very clear lineage of that data and how that data has been propagating from system to system. So with such a system, we can have that level of consistency and lineage to be able to accurately create a report as of a particular given date and time. And of course, this platform is adaptable. We can make schema changes. We can add more data to this platform as we go on and incrementally build this out. So it helps financial services firms stay in compliance, and provide, as I mentioned earlier, the graph analytics on top of this. So You might do what if scenarios, as you do new trades, for example, to assess the risk level. You might look at different traders and how they're performing. So these are all different types of business analytics that you can get by connecting these data sources together, which will help the business run better. And finally, of course, this is a future-proof platform which easily adapts to new data sources and a new risk model. And as regulations change, again, since you're reporting out of the operational system, that can be easily managed as well. So let's move on to demonstration. We have Harlan Duman, who is a solutions engineer, who will be leading us through this demonstration.
In this demonstration, we'll be using Bloom, which is a product built by Neo4j that allows technical and non-technical users alike to visualize their data and gain insights from the exploration of that data. So let's start by exploring the data model that we're going to be working with. So at the top level, we have trading desks. So we can just type into the search bar at the top, trading desk, and find the 3 trading desks in our data set. We have an energy desk, a transportation desk, and a technology desk. Each of these desks has positions in either baskets or equities. So if we expand out the relationships that this node has, we can see interactively which equities and baskets it's trading. So the equities are these nodes in green, and the baskets are these nodes in purple. And we can also expand out these baskets to see that baskets can have positions in other baskets and can also have positions in equities as well. The data model is simple for the purpose of demonstration, but it can be easily expanded based on the structure of the organization and the different types of investments and assets. Neo4j does not lock you into a difficult to change schema, so you can incrementally add to and change the schema as business requirements change. So for the purpose of this demonstration, we're calculating risk on an equity level, and each equity has a risk value associated with it, and we're also aggregating that risk up to the baskets that trade that equity and the trading desks that trade that equity and the baskets that it trades. And Nav can talk a little bit more about the methodology we used to actually calculate risk.
Yeah, so risk has been calculated with a simple approach over here for demonstration purposes. So we use RSI, which is a relative strength indicator for a particular stock, and ROC, which is the rate of change. And we aggregate those two, which is basically statistically showing, how the stock is fluctuating over time, and increase in fluctuation is basically an increase in risk. That's how we look at it, and we aggregate the two metrics and then calculate risk based on that. So, realistically speaking, though, every financial services organization has a different approach, and a lot of it is proprietary in how they calculate risk. Those are sort of the crown jewels of these organizations. So they will be implementing their own risk methodology here in a real situation, but we're just simulating it with a simple approach.
All right, so data lineage is an important aspect of building risk models, and Bloom allows us to easily see the full data lineage for any equity. So let's clear the scene here, and we can type in plain English up in the search bar, lineage of, and use the name of any of these equities that we have in our data set. So let's look at the lineage of NVIDIA. And this is a feature of Bloom that you can define these plain English search phrases to explore your data in whichever way you want to. So if we look at the data lineage for NVIDIA, we see the 24 price points we have on it, and we see how it's actually traded in our organization. So it's traded by these two baskets, this artificial intelligence basket and the electric and autonomous cars basket, and those are traded by these two desks, the transportation desk and the technology desk. We can also see data lineage at the trading desk level. So if we clear the scene here, we can use that same search phrase, but type in the name of a trading desk. So let's look at the data lineage for the transportation desk. and then we can see every equity it trades and exactly how it trades those equities.
So the blue circle there is the trading desk, the baskets are represented in purple, and the equities in green, as you see in the legend here. So you can see kind of the lineage going from the trading desk all the way to the equities, and then Harlan, if you just expand any one equity, you'll see the 24 price points.
So we can also interactively expand at the equity level and see their data lineage in the same screen.
So you can see that the model we showed on the PowerPoint slide earlier is reflected back here in this data model.
So the data that we're looking at here has static prices and risk scores, but in the real world, prices of equities are going to be updated continuously, and risk models need to be able to recalculate risk in real time as that happens. So to simulate a market import, I'm going to open up the Neo4j browser, and I'm going to run a script to load in new data for risk scores and prices. I'm going to re-aggregate that risk at the trading desk level and at the basket level. And I'm also going to generate alerts based on how the data has changed. So if I go back into Bloom and I reload, all that new data is going to be available. And I can, for example, clear the scene and find alerts by just typing in alert. And I can see all these new alerts have been generated based on increases in risk score. And for any of these, I can expand out to see the node that it relates to and the company that issues that equity.
So if you've just been following, we've really, what we've done is ingested real-time data from the market, and immediately we've been able to recalculate risk based on the new stock prices, the new RSI and ROC scores of these equities, and we've generated alerts. So this is something that would be then sent out to the traders, the relevant trading desks and the traders associated with them, and they would act on these alerts. So all of this has happened in real time.
And we can see, for example, for this specific equity, the reason that this alert was generated was because the risk score went up from 5.47 to 9.26 in that latest data import. And this can, of course, be adjusted to generate alerts based on whatever criteria fits the business requirements. So another aspect of risk management is understanding the crossover between trading desks and seeing which equities are traded in multiple different places. There may be more exposure than previously realized on these highly connected equities. Since the connections and data are first-class citizens in Neo4j, it is the perfect tool to quickly find and detect these potentially risky assets. So I'm going to type in a search phrase I have defined, connections between trading desks. And this will show me all the equities that are traded by multiple trading desks and the lineage back to those trading desks. So if I trace any given equity, let's say Intel, I can see it's traded by this artificial intelligence basket, which is traded by the technology desk. It's also traded by the electric and autonomous cars basket, which is traded by the transportation desk. This sort of search phrase can be customized and made more specific based on what your organization wants to find out about the data. For example, you may want to see trading desks that share more than 50% of their equities, and Neo4j can answer these types of questions in real time. Interconnectedness might also show up in one specific trading desk. Finding equities that are highly connected in a specific desk can also help you discover high-risk assets, as well as help you evaluate the trading structure of the organization. So I'm going to type in another search phrase that I have defined. Connected equities. And let's look at the technology desk. So here we can see every equity that's traded in multiple ways through the technology desk. So for example, we can trace back Cisco, and we can see that it's traded through this cloud computing basket as well as this electric and autonomous cars basket. And the electric and autonomous cars basket is also traded through the artificial intelligence basket back to the technology desk. And so using this type of query, you can understand if you have multiple baskets within the same trading desk trading the same equities.
And so based on this information, a trading desk or the management of the firm can decide, if there's too much commonality across baskets or across trading desks, maybe there's a need to review sort of the description of the desk, the overall business purpose of the desk, and change that, or split up a basket or split up a trading desk. And takes those sorts of business decisions based on this data to have a better trading approach.
Exactly. So, for example, with Tesla, we can see just how highly connected it is within this one trading desk. It's traded by multiple baskets, and those baskets are even traded by themselves. So this is an instance where the organization may want to look further into how their baskets are structured and how Tesla is traded throughout this desk. So we can also use Bloom to visualize the answer to more straightforward risk questions. For example, we can type in top 3 highest risk trading desks to see our riskiest trading desks and see their risk scores. And we can as well type in top 5 highest risk baskets to see the risk for those. And we can start to try to find connections in this data and explore outwards by looking at the relationships for each basket and seeing relationships that they have from trading desks. So as we start to expand out these relationships, we can start to see that there's actually a lot of interconnectedness in these 5 riskiest baskets. And so we can see how this risk is sort of aggregating upwards towards the technology desk, which is the riskiest trading desk now, and how many of the riskiest baskets, their risk is aggregating up and affecting the risk of that desk. So we can get a more clear understanding of why a trading desk is riskier than the other trading desks.
And so if you look at this, the highest risk is coming from the internet basket and then the cloud computing basket. And so if you expand that out, you will get all the equities associated with that, and what is the source of the high risk there, and you can kind of go through this list and see, you have Amazon, you have Microsoft, and equities like that are contributing to the risk levels. And if those equities are being treated through multiple ways, then that will just compound the risk. So you can do these type of analysis with this data very effectively and very, very quickly in real time.
We can also explore risk from the bottom up, starting with equities. So I'm going to type in the search phrase we have defined, top 10 riskiest equities. And we can see these 10 equities that have the highest risk value associated with them. And we can expand outward these relationships that these equities have to see where they traded and are there commonalities between where they're traded. So even as we're just expanding a few here and there, we can start to see that there's clusters and that several of these equities are traded by the same baskets and will also be traded by the same trading desks if we go further up the chain. We can also look at other risk indicators, such as the equities with the biggest price movement. So I can type in top 5 equities with the highest price movement, and I can see these equities moved the most in price over the last year. Similarly, I can ask for the top 5 equities with the highest risk movement. And as we can see, there's no crossover between these 5 equities on either side, but we can type in another search phrase that we have defined that does the combined price and risk movement for the last year. And there we actually see that there is a lot of crossover between these 2 groups, as well as there's 2 new equities that have shown up. So let's dismiss all the other nodes that weren't returned there. And now we can kind of explore outwards from these nodes and also, again, try to find connections in the data.
So we can look at this data and see, these five equities have the combined highest risk and price changes, and so if most of them are connected to the same basket or to the same trading desk, then that has major implications to that trading desk and basket, and so we can do that kind of exploration with this data and understand how risk is being essentially transferred across the organization, across different trading desks and baskets.
And we can see again the technology desk pops up and the same baskets we've been seeing pop up. So we can see why is it so risky and how is this risk bubbling up at the low level at the equity level, where we can see which are the riskiest equities and how they are affecting our overall risk profile. So all of these data exploration examples were chosen to demonstrate how to use Bloom to extract value from your data and create a more comprehensive risk management solution. Bloom is flexible though, and you can define whichever search phrases over here are appropriate for your specific use case.
And there's more interesting things you can do with this data. So for example, if you're entering into a complex trade and you'd want to look at the risk picture before and after the trade to make sure that you want to go forward with that trade or not, you can do those sorts of real-time risk measurements with this data. So you can kind of simulate the trade effectively with this data set and readjust the risk scores and see if they fall within the threshold of acceptability, and then go ahead and execute the trade. And all of this can happen in real time, so it doesn't impact the trading. Harlan, thank you for that fantastic demo. In conclusion, I just wanted to mention that most strategy consulting firms, including McKinsey, agree that implementing investment risk management and FRTB compliance together in this smart manner and upgrading their trading infrastructure from front to back is really required to address these requirements of FRTB, because the Basel study recently done found that 70% of banks cannot adequately explain their P&L and its drivers, and having such an integrated system that assesses risk on a daily basis will go a long way towards that. Banks have been really given a golden opportunity to get their trading houses in order and use these type of advanced technologies to thoroughly remake their risk management platforms. And this will help produce reliable, fast, high quality measurements as required by these compliance efforts. And we're actually seeing leaders and change agents at leading financial services firms actually starting to develop proofs of concepts for such risk management platforms using advanced analytics and AI. And these provide ways to capture a higher share of the efficiency gains in a shorter time frames and at lower cost, so leads to better transparency, enhanced risk management, and greater operational resilience, as we have shown you throughout the demo. So again, I think this is really directionally what banks have to aspire to build, a future-proof risk management platform to support not only the regulations that are coming their way, but also to help increase transparency, more efficient use of the capital that they have. So finally, just to conclude, as you can see in the demo, Neo4j really helps manage highly interrelated and connected data very effectively to trace lineage all the way back from trading desk to price points, and then aggregates risk factors, and merging all the different silos around trading, fund management, pricing into a unified data set will really help assess risk in a more holistic and uniform way. And then visualizing that risk through our Bloom product really helps understand and visualize the analytics that can be provided to both management and traders on top of this data set. And obviously keeping pace with the changes in market conditions, changes in the regulations, and so forth can be easily done with this adaptable platform. So thanks again for listening, and you can visit neo4j.com, use cases, privacy, risk, and compliance, the URL down there for more information.